Welcome to episode 2 of the Tax Lady podcast. It's the holiday season, and how do you motivate yourself during this time of the year? I hear many people even complaining about things like holiday shopping or having to put up that Christmas tree and getting into the holiday spirit. While I keep getting asked do I motivate myself to prepare for tax season or an audit? I usually answer that I've always been passionate about finding the mistakes of other people. So how do you audit, and what exactly is an audit? Having worked audits, this is what a typical framework of a real estate professional status audit might look like. All audits follow a set of structural framework set forth by the U.S. government and the IRS. But before I tell you what the auditors are looking for, you have to know to think like an auditor. Every audit follows a technique guide, and every auditor comes into the audit with a mentality that you are wrong and they are right every time. The reps, or real estate professional status, is a highly litigated area. It's really important to understand how an auditor will come in and try to impose an IRS penalty on you. You really have to prove your case and prove that you are in fact a real estate professional. The Revenue Reconciliation Act of 1993 allowed real estate professionals who spend the majority of their time engaged in real estate activities to avoid something called passive loss limitations. I'll get into depth on passive loss limitations in my later episodes when we cover rental losses. But a passive loss is basically a rental loss or another form of financial loss within an investment in which the investor is not a material participant. Something that most real estate investors don't qualify for because they are not real estate professional status. One way to avoid this limitation is to determine if you qualify as a real estate professional under the U.S. tax code. Real estate professionals can claim unlimited losses on rental properties they materially participate in. But while this designation sounds simple enough, there are many rules involved in qualifying for one. But before I get into who can qualify as a real estate professional, let's first clarify who probably can't qualify. While there is a remote possibility that one of these people could be eligible, based on a long history of court cases since the enactment of this code section, these are the ones who are most likely to run into trouble. People who think holding a real estate agent's license automatically qualify them as a real estate professional. While holding a real estate broker license can help, holding a realtor or agent's license isn't any more beneficial than, say, having a teaching credential. And taxpayers who have full-time jobs in other fields unrelated to real estate. This is because the hour requirements spent on your own rental holdings are significant, as well as taxpayers who have hired a property manager to manage their day-to-day activities of the rental properties. Taxpayers who are terrible at record keeping, as well as because of the hours required to meet the real estate professional status in case of an audit. The IRS wants to see a log of your time that you spend on your rental property, and the court goes hard on taxpayers who determine their hours using ballpark guesstimates. If you elect the real estate professional status, the auditors will first look at your income stream. They'll look at how much time you materially participate or actively are involved in the operation, like a real estate investment activity, and look at that against your income stream. Who's really the real estate professional? If you are married and file jointly, is it you or your husband or wife? The IRS will assess for material participation under the 750-hour rule. They're going to scrutinize your other income and even volunteer work against the time you spent in your real estate activities for material participation. The key in proving you are in fact a reps is the time test. Auditors will audit your real estate professional status on the basis of 5 to 10 principles. So they're going to ask for time record keeping records. They're even going to record if you do your time record keeping during the audit. And if you go to tax court, that's going to go against you. You have to have your story straight every time and in case you get audited. For time record keeping, you can use Excel or even your cell phone using some time record keeping app. Good accounting is the difference between a higher likelihood on winning an audit or losing an audit, if you ever get audited. Failing to tax plan your investment portfolio throughout the year may trigger an IRS audit. Any number of things can trigger an IRS audit. Unconfirmed deductions, missing income, huge business losses. Failing to report holdings of cryptocurrency can even land you in the hot seat with the IRS. If you're a real estate investor and you manage it yourself, you'll be writing off legitimate expenses related to the rental property, such as repairs and depreciation. Problems arise when property owners get aggressive, writing off too much for the property or claiming deductions that they shouldn't be able to deduct. While the IRS gives property owners some flexibility in claiming deductions, you are not given full discretion. And real estate investors will need to prove deductions if the taxman ever comes knocking. If you sell real estate, you've earned a profit. Congratulations, but you now have a capital gain. You will owe tax on that rate depending on whether you held the asset for more than a year as well as your taxable income. If you fail to report the gain, the IRS will become immediately suspicious. While the IRS may simply identify and correct small losses and ding you for the difference, a large missing capital gain could set off the alarms. Cryptocurrency is a big area of enforcement right now. So if you trade, hold, or use any cryptocurrency, you may be target of an audit or a compliance check. The IRS wants to be paid, and it wants to be paid on time. That can be difficult for some investors, especially when some investments may be complicated or year-end statements may arrive very late in the tax season. While an investor's tax returns may be more complicated than the average return, the IRS still wants a timely filing. Simple things can keep you from an audit, including paying your taxes on time, filing on time, and acting immediately on an IRS audit. For those investing in real estate, keep track of all your rental expenses and deductions. Evidence is key to winning an audit. Most real estate professional status lose audits because of poor record keeping or not being able to prove anything. If you are planning to elect the real estate professional status on your next tax return, your accountant can help you with record keeping and logging in time that's material participation in a real estate investment activity. But most accountants are generalists. Your current accountant is probably not a real estate investment tax specialist. Imagine you are forced to take an eviction action on a non-paying tenant. Are you going to hire a generalist attorney to help you? Or one who's an expert in evictions? Smart investors choose the last mentioned. The same can be said about accountants.